Do not buy a house in 2025. Do this instead.
Welcome to the Mindful Millionaire, the #1 self-improvement channel in the world. This channel is your go-to space for mastering mindfulness and money habits to create lasting wealth and inner peace.
What's up, guys? Today I want to break down something that could affect just about everyone watching this. Warren Buffett has just issued a serious warning for the housing market. Now, I know the internet is full of housing crash predictions and doom and gloom headlines, but here's the difference. This isn't coming from some random YouTuber. This is coming from Warren Buffett, one of the greatest investors of all time. This man has beaten the market for decades, built Berkshire Hathaway into a $900 billion empire, and outperformed almost everyone in history. When he says something about investing, it's worth listening to. And this time, his comments about real estate are pretty shocking. Buffett's past view on housing. Let's rewind a bit. Back in 2012, during the aftermath of the great financial crisis, housing prices had absolutely collapsed. Buffett said if it were practical, he'll buy up a couple 100,000 single-family homes because they were such a bargain. At that time, mortgage rates were around 3%. Prices were dirt cheap and the math was clear. Buy a house, hold it for decades, and you'd do really well. He went so far as to say that under those conditions, housing was better than stocks. But now, Buffett has completely flipped. At his most recent shareholder meeting, he said real estate no longer looks attractive. And when he broke it down, the reasons were eye-opening. Point 1. Stocks are simply easier. Buffett's first warning is that real estate is much harder than stocks. Think about it. Over the last century, US home prices have grown at an average of 4.3% per year. After inflation, that's about 1.3% real growth. Not bad, but nowhere near the stock market's historical 9.8 average annual return with dividends reinvested. Yes, real estate has advantages. Rental income can add another 2.6% annually. Leverage can turn small down payments into massive return if price increases. It's also a hedge against inflation. But here's the trade-off. It takes a ton of work. You've got to find the right property, negotiate, pay closing costs, manage tenants, handle repairs, deal with vacancies, and cover property taxes and insurance. Meanwhile, with stocks, you can buy an index fund in 30 seconds and then literally forget about it for 20 years. And that's exactly Buffett's point. He said it's so much harder than stocks in terms of negotiation, in terms of time. There's just so much more opportunity in the stock market than real estate. Point 2. Stocks offer better bargains in downturns. Buffett's second big point. Historically, whenever there's a downturn, stocks usually fall much harder than housing. And for an investor like him, that means more bargains. Let's have a look at history. 1929, Great Depression. Housing dropped 67%, but stocks collapsed 89%. 1990s, Savings and Loan Crisis. Housing prices stagnated for nearly a decade, but stocks gave investors plenty of time to buy the dip moments. 1990s, Savings and Loan Crisis. Housing prices stagnated for nearly a decade, but stocks gave investors plenty of buy the dip moments. 2008 Financial Crisis. Homes fell 30 to 80% depending on the region, but stocks fell over 50% in just months. 2020 Pandemic Crash. Stocks dropped 34% in just 23 trading days. Housing barely moved, then actually went up afterwards. So Buffett's right. If you're looking for bargains, stocks offer way more volatility and therefore way more opportunity. Point 3. Liquidity matters. Another thing Buffett pointed out, liquidity. With stocks, you can buy or sell instantly. You can move billions of dollars in minutes anonymously. But real estate? It can take weeks or months to close on one property. Every deal turns into negotiation with sellers, with inspectors, with lenders, with contractors. Buffett summed it up like this: you're dealing with a single owner. To them, it's an enormous decision. When you walk down to New York Stock Exchange, you can do billions of dollars worth of business totally anonymously in 5 minutes. In real estate, it's a whole different game. And that makes scaling in real estate much harder. Why this matters right now. So, why is Buffett bearish on housing today? The big reason: interest rates. Back in 2012, you could borrow money at 3% and lock it in for 30 years. That made sense. But today, mortgage rates are around 6 to 7%. That's double the cost of borrowing, and it completely changes the math. Many properties that would have cash flowed 5 years ago are now losing money every month. On top of that, housing affordability in the US is at its worst level in decades. The National Association of Realtors reports that the average homebuyer now spends over 35% of their income on housing, the highest since 1985. That means fewer buyers, less demand, and a tougher market overall. Case study: Wall Street buying homes. Another layer is that big institutional investors like BlackRock, Invitation Homes, and private equity funds have been buying up single-family homes by the thousands. For everyday buyers, that means you're not just competing with another family. You're competing with billion-dollar funds who can pay in cash and outbid you. This has kept prices artificially high in many cities. But here's the issue. Even these big players are starting to slow down because the higher interest rates are squeezing returns. And when the big money pulls back, this could create a ripple effect. Global housing trends. And this isn't just a US issue. Globally, housing markets are looking shaky. In Canada, home prices surged over 50% during 2020 and 2022. Now, sales are slowing down. Affordability is the worst in Canadian history. In the UK, mortgage rates doubled in the last 2 years. First-time buyers are struggling, and some analysts are predicting price drops of 10 to 15%. In China, their housing market has been in crisis for years, with developers like Evergrande defaulting and millions of unfinished apartments sitting empty. So it's not just Buffett. Warning signs are flashing worldwide. Future risks to watch. On top of that, there are new risks on the horizon. Remote work. Many companies still haven't decided whether employees should stay remote or return to the office. This uncertainty is reshaping demand, especially in big cities. Demographics. Millennials are hitting peak home buying age, but Gen Z is entering the workforce with record debt levels. Will they even want or be able to buy homes? AI and automation. Technology is transforming how people work, where they live, and what jobs exist. This could shift housing demand in unpredictable ways. So, what should you do? Here's my takeaway. If you're buying a home to live in long term, housing still makes sense. It's stability, it's inflation protection, and it's a roof over your head. If you're looking purely for investment returns, stocks are easier, more liquid, and historically more profitable. If you're chasing real estate deals, you need to be extremely selective in today's market. Look for undervalued properties, landlord-friendly states, and mortgage terms that make sense. And above all, don't expect real estate to make you rich overnight. It's a long game. And as Buffett said, stocks often provide better opportunities with less effort. Final thoughts. At the end of the day, Warren Buffett isn't saying real estate is worthless. He's saying that at today's prices and interest rates, it's simply not the best opportunity. For him, it makes more sense to buy stocks. For you and me, the answer might be different depending on your goals. But his warning is clear. Don't assume housing is always a good investment just because prices went up in the past. The math has changed. So, what do you think? Is Warren Buffett right? Is housing still worth investing in, or are stocks the smarter play right now? Drop a comment below. I'd love to hear your thoughts. And as always, smash that like button, subscribe if you haven't already, and I'll see you in the next one.